I'm befuddled, actually. I'm not usually at a loss for words, but I just, it's amazing, right? You go back to January this year, and that was supposedly going to be the most important, FOMC because, the Fed was gonna pivot. They were going to stop raising rates and they were going to pivot, and that's why the markets took off. They never pivoted. He never pivoted. Now he finally says, yeah, we're probably, he didn't say it this way. Yeah, we're going into election year and I kind of want to keep my job. So yeah, I'm gonna lean dovish for next year.
On Wednesday, the U.S. Federal Reserve announced a much-awaited pivot, signaling that it would cut interest rates 3 times next year as it predicted inflation would cool. Despite this being a much-awaited announcement, economists and Wall Street analysts have had mixed reactions to the news. Global stocks and bonds have risen significantly, with investors buoyed by widespread optimism that the period of tight credit is coming to an end. The S&P is closing in on record highs, currently trading at its highest since the January 2022 peak. Investors are betting that the Fed will be able to pull off a soft landing after all, and all seems to be right with the world again. However, veteran investors and analysts are raising questions about the rally and whether this is really the right time for a Fed pivot. To begin with, just about a year ago, such a sudden and significant surge in stock prices was almost unthinkable. And now that prices are soaring, experts are asking if the Fed can really deliver rate cuts next year. These experts point out that U.S. consumers are still spending, especially evidenced by all the holiday spending. According to recent reports, retail sales exceeded expectations in November, likely keeping the economy on a moderate growth path this quarter and further alleviating fears of a recession. So if consumers are still spending, and the economy and labor markets are still growing robustly, why is the Federal Reserve announcing a pivot it practically swore against for more than a year? This is why experts are worried that the Fed's announcement will again let the inflation genie out of the bottle. According to popular economist David Rosenberg, interest rate cuts would suggest that the U.S. is on the brink of recession, an economic condition the Fed and Treasury Department have strongly denied for the past 12 months. Renowned hedge fund manager Yusko believes the answer to the Fed's mixed signal puzzle is not particularly far-fetched. Mark and other prominent crypto investors have been predicting and talking about this since the rate hike started in 2022. 2024 is an election year, and no Fed chair that still wishes to keep their job will remain dovish into such an important year for U.S. politicians. But what happens to the working class if inflation again becomes uncontrollable? We hope to find some answers in this video, which features clips from the latest episode of Mark Yusko's weekly roundup with Blockworks Macro. Please take a little time to like and share this video, subscribe to the channel if you have yet to do so, and turn on post notifications for more videos like this. Thanks, and enjoy the video.
Like the whole year, kept raising rates, and everybody's like, "Oh, well, he's going to pivot next meeting. He's going to pause." And it's amazing when you go back and you look over the course of the year, how people just like cut him a pass and pushed valuations up back to nosebleed levels in terms of PE ratios and price to sales. Oh my God, some of the craziness. And yet he did nothing. And so to your point, now he finally says, yeah, we're probably, he didn't say it this way. Yeah, we're going into election year and I kind of want to keep my job. So yeah, I'm gonna lean dovish for next year. And this is insane, right? The people, and I was probably in that camp, that were recession watchers at the beginning of the year have been befuddled, right? There's been no recession. I mean, in fact, we've had pretty spectacular growth in the first couple quarters of the middle 2 quarters, second and third quarter. Fourth quarter is looking a little weakish, but that's not come to fruition. And so the idea of cutting rates, and yes, the dot plot says March, but the futures market says January. There is no way they should be cutting rates. We're not even back to the middle of the range. We're at the very bottom of the normal range over the last 70 years. It's nonsense. This I don't know, Pavlovian interaction by we got to keep the stock market up. We got to keep the stock market up. And I get it, right? The liabilities, the federal government liabilities for Medicare, Medicaid, Social Security, et cetera, can't be funded, right? It just full stop, can't be funded. We don't have enough money. We can't collect enough money. Got a big, huge deficit. So the only chance they have is to keep people happy-ish by keeping home values inflated and 401ks up. So I think that's what this is all about. It's just manipulating the market. It's so ridiculous. It's so ridiculous, right? Yeah, I mean, it's absolutely ridiculous. So what you're telling me is all the 120 years before the Fed, the last 120 years, we needed to cut rates when interest rates were this level. That's just gobbledygook. It's so frustrating in that the idea that the financial conditions are tight is ridiculous, right? Look around. I mean, look around. Look around. Okay. Prices of stuff, they're not going down, they're going up. And activity levels are high, traffic is bad, airplane traffic is high, hotels. I mean, that's just, look, she's the queen, literally the queen of Fed speak, right? Fed speak is where you say a lot of words and you actually don't say anything. And she's very good at it. And what's so crazy about this is I get it. They realize they made a huge mistake in 20 and 21 by doubling the money supply. Right? I get it. They figured out, oh yeah, that was kind of bad. Kelton was wrong. So yeah, that's bad. And so for the first time in history, they're contracting the money supply. Not first time in history, first time in the last 110 years. They're contracting the money supply. But we got a long way to go. I think the only thing we're missing is there is a lot of breakage in the real estate world, in the banking world, regional banks that lent to these real estate projects. And we're in this extend and pretend world, right? Where the Fed has said, oh, don't worry, you can put back your bonds to us at par. Don't worry about the losses. They don't count. But they haven't said anything about real estate losses. And I guess the only way you can fix that is to not foreclose and then get back to an environment where the rates are lower so you could refinance the bad debt and push it out even further. And maybe that's what this is all about. They realize that you can't function in a overly leveraged society if interest rates rise.
What does this mean for asset prices?
Well, they're going to rise, right? I mean, any long duration asset is going to rise as interest rates fall. Your discount rate changes, and people start dividing future cash flows, which are uncertain, by a lower number, and the net present value goes up. So people buy.
Mark also talks about the famed hard and soft landing during the interview. When the rate hikes started in 2022, many analysts and veteran investors warned about a hard landing, a scenario where the Fed hikes rates too fast and too high, causing a severe economic downturn. The other scenario, which Fed Chair Jerome Powell and Treasury Secretary Janet Yellen predicted was going to be the case, is a soft landing that brings inflation under control without any serious damage to the economy. Mark reckons we already had the recession last year, and what we have now is a no-landing scenario. A no-landing scenario involves the economy continuing to grow despite the Fed's best efforts to tamp down inflation with interest rate hikes. While he admits that a pivot is all wrong at this time, Mark is certain it will be great for crypto asset prices, especially as we head into a halving year.
I'm probably of the opinion the other way, which is the rise in rates was anomalistic because demographics are destiny. Every single day, this country gets older and less productive and more prone to hoard bonds, not spend as much, downsize. And that is all deflationary, not inflationary. And that is all pointing to much lower rates, much slower growth. Just look at Japan. And, that's probably what this is, right? Is we had this policy error, which was the printing of too much money. And we had the devaluation of the currency, right? I will argue not inflation, it was devaluation of the currency. And now we're having to unwind that, plus go back to acknowledging that we got 82 million boomers that are going to start asking for their handouts. Right? I'm 2 years away from getting free healthcare for life, according to my retirement plan. I get free healthcare for life from the state of North Carolina, in theory. Now, I know they don't have the money. I know it, but I'm still going to ask for it. And so is everybody else going to ask for all these benefits. And the cupboard is bare. The cupboard is bare. And so you can print it, but then you got this problem that we've seen, right? Which, again, I don't want to go down to Sinister Saturday. We haven't done that in a long time. But if that was the plan, that you're trying to increase the wealth divide, you're trying to concentrate the wealth at the top, they're doing a damn good job. We had no landing. I mean, I think it's a ridiculous phrase, right? No landing. Well,
Yeah.
we had a touch and go, to use aeronautical, aeronautical terms. So look, we can debate endlessly. First and second quarter 2022, was that a recession? I will vehemently state forever it was. Now you can say, well, but employment never came down. Like, yeah, because you juice the numbers because of the way you don't count people over 65, whatever. Fine. You don't want to call it a recession. I don't really care.
Yeah.
Touch and go, right? Since that time, we don't have recession. We have economic expansion. Surprisingly hot. Now, I can make the case that the third and fourth quarter of 22, totally manipulated by release of the SPR for election purposes. Doesn't matter. That's how they count the numbers. That's the one thing, is we can complain about how they count the numbers, but those are the numbers. So to say that there's a recession, well, but they didn't call a recession. So stock market went down 25%. That's a recession, right? 650,000 people lost their jobs in the tech space. That's a recession. But you don't want to call it a recession? I don't care. Now we're in economic expansion for sure, right? 5% quarter? Come on. No matter how you look at it and say, well, but this doesn't really count because it's government spending and it's deficit. It's the number. And this quarter, it's heading towards 1. So it's heading for the hard deck. What the dot plot is telling me is what we actually talked about this last week. First quarter, GDP is going to be negative. It's not going to be like a blowout negative, but it's probably going to be negative. And that's the seasonal adjustment that they never seem to get right. So it's always the weakest quarter. But that's what the dot plot is saying. And so are we going to get a soft landing? Well, we had a soft landing. We actually had a no landing, a touch and go. Now we're on ascent, but now maybe we're losing altitude. Maybe we're like, oh, geez, we should have stopped and got fuel. Maybe we should have got fuel. So that's kind of where I think we are.
When the Fed started hiking rates in 2022, investors and analysts warned that it had allowed inflation to stay too high for too long before springing into action. And now, we are having the same conversation about the Fed reacting too quickly or too slowly to a situation and bungling everything up. While some people chalk this up to a very extreme case of inefficiency, Real Vision founder and CEO Raoul Pal believes these are deliberate actions to mislead the public about what the Fed really wants to do. According to Pal, the US government needs a big reason to print massively, such massive money printing that it would dwarf the proportions of what was done in 2020. However, doing so will raise a lot of suspicions and shift public opinion against the present administration. This is why Pal believes the Fed needs an excuse. And what better excuse than cutting rates 3 or more times in 2024, with inflation still very well in the background and waiting to rear its ugly head again. Double-digit inflation, for instance, will give the Fed the excuse to jerk up rates even much faster until we hit that massive breaking point Jerome Powell has been fantasizing about. When that happens, the Fed will be free to print as much as it wants. Then we do all of this again in another 3 to 5 years. But the real clincher is people will not even realize what's happening, because we will be deeply caught up in all the election drama. It's the perfect crime. What are your thoughts on Mark Yusko's interview? Do you agree that the Fed cutting rates next year will bring more economic woes for Americans? Please drop your comments and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos. Thanks for watching.
Hey Savvy Finance enthusiasts, massive shout out for being the heartbeat of Savvy Finance. Your support has been the wind beneath our wings, and we can't express our gratitude enough. Now buckle up because we've got an exclusive deal just for you. Ever wanted a slice of the action? We're offering a golden opportunity to own part of our YouTube channel's potential future revenue. This isn't just an investment, it's an invitation to be a part of our story. Investing means you're not just an investor, you will be a participant in the future of Savvy Finance. No cheesy lines, just a genuine call to embark on this journey together. But wait, there's more. Your mission, should you choose to accept it, become a Savvy ambassador. Share our videos on every platform: Facebook, Twitter, LinkedIn. Your shares amplify our visibility, potentially translating to more views and more YouTube revenue. Here's the kicker. If our viewership increases, we would not be just growing financially. We would be making a tangible impact by spreading valuable financial education. Now the icing on the cake. Invest and you'll score exclusive access to our private Savvy Finance Discord. Here you can chat with Savvy Finance, swap ideas with fellow investors, and be at the forefront of exciting developments. Click on the link below to register your Gigastar account. You can also find the link to my offering page in the description below. Get your Gigastar account ready, review the offering details, and let's embark on this thrilling venture together. To the incredible Savvy community, thank you for being the backbone of our success. Your journey is my journey, and together, we're creating waves. Cheers.